Let's see what are some more deductions and additional depreciation conditions which have been provided in this budget. And probably this is the last video that we are discussing, where we'll cover the balance amendment. Now, this deduction of allowance of balance 50% additional depreciation AY 1617 onwards is something similar to what we discussed in the case of benefits of Andhra Pradesh and Telangana. What happens is that if a person acquires an asset in the second half of the financial year, okay, then he's allowed 50% of the depreciation which is otherwise allowable, right? So if I buy new plant and machinery, even the additional depreciation which is available to me under the existing provision at the rate of 50% is allowed instead of 100% on new plant and machinery acquired during the second half of the year, right? This may dissuade a person from making those investments. So therefore it is proposed that wherever you acquire the asset in the second half, because of which you are entitled to 50% of the normal depreciation, then the balance additional depreciation of 50% will be allowed to you in the next succeeding financial year. So if I buy an asset in financial year 13-14 on, let's say, December 1, I get 50% of the additional depreciation at the rate which is allowed to me. The balance 50% will be allowed to me in financial year 14-15. In order to encourage the recruitment of more and more workers to create employment, under the existing provision, benefit is allowed to corporates, assessees, who employ more than 100 workmen during the year. In order to encourage even other forms of organization, now the benefit is proposed to be extended to all assessees who have manufacturing entities and are employing more than 50 workmen. So instead of 100, even if you employ more than 50 workmen, you will be allowed a deduction. The deduction is what? The deduction is 30% of the wages paid to new workmen in excess of 50 during the relevant previous year. So the idea is to encourage more and more employment by the manufacturing entities. Let's look at some of the other amendments. The good news is the wealth tax has been abolished effective 1617. Instead, a surcharge of 2% is levied on the super rich earning more than 1 crore a year. The deduction under Section 80G is expanded to include 100% deduction for contribution to the National Fund for Control of Drug Abuse, 100% deduction for contribution to Swachh Bharat Kosh for any donor, okay, and domestic donor to Clean Ganga Fund. If you are incurring any CSR expenditure covered under the provision of Companies Act, that is not going to be covered here. That is not going to be allowed as a deduction. Income of these two funds shall be exempt from tax. So Swachh Bharat Kosh and the Clean Ganga Fund, whatever income they get, that is going to be exempt from tax. The provision for TDS have been simplified. The correction of TCS return now permissible on the line of the correction for TDS. TCS statement will also be processed just like the TDS statements. This is again an important amendment, TDS on non-resident remittances. Now, any payment that you make to a non-resident, you have to make a declaration of such payment to the non-resident even if TDS is not deducted. Okay, and if you fail to disclose such a payment, it shall result in a penalty of rupees 1 lakh. Again, whatever payments are being made by the EPF, there will be a TDS deduction on that at the rate of 10% on premature withdrawal of EPFS above rupees 30,000. Right? The employee, if he thinks he doesn't have a taxable income, may give a self-declaration for nil withholding, or may pay taxes as an advance tax or declare to the new employer as the case may be. He has to furnish the PAN, or else the withholding will be at the maximum marginal rate. The next amendment relates to the concealment for income. Now, the tax office has been arguing that, when you pay MAT, right, even if you are paying taxes under MAT, if there's a concealment of income under the normal provision, penalty is leviable, while the assessee has been arguing otherwise. To set to rest this controversy, it has now been provided that if you conceal income under the normal provision, even if you are liable to pay MAT, the penalty can be levied. The TDS on contractors, which is in respect of the transporters, is not applicable if the recipient is computing income under Section 44A.